complete guide. Hello, everybody. This is StockerFinance, and I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance to ask any questions and for more financial news as well. So, this is going to be a total overview from gathering capital all the way to placing trades and how to do each of that. A lot of people have been getting into investing during the pandemic, being at home, etc. There's been a lot of interesting things going on with the stock market and other markets as well currently. So it's a really interesting time to get into that. And I thought I'd make this video because I've gotten a lot of questions about tips, tricks, how to get started, etc. So this is a summary. We're going to start out with gathering capital, then education. Then we're going to talk about opening a brokerage account, then the different types of investments you can make. We're going to talk about choosing strategies, how to choose a stock and analyze a company, the types of trades and different orders, and as well as just placing your first order and how to do that. We're going to talk about selling and understanding when to exit, which can be very difficult to do. And I'm also going to give you some of the best investing advice I've ever heard, and then I'm going to give you a little outro at the end. I'm going to put timestamps next to all of these, so if you've already done a couple of the first ones or you already know the basics, you can skip through and maybe you just want to see how I analyze companies, or you just want to learn how to choose an investing strategy. If you just want a couple of them, you can skip through. I also have individual videos on my channel that go through each topic in more detail. Some of those may not be out yet, but they are coming out soon if they're not. All right, so we're going to start with gathering capital. The first thing you need to invest is money. If you ever hear you can start investing with no money or how to invest with $0, it's not possible. Don't do it. All those videos are either scammy, they're going to talk about loans, they're going to talk about just going and getting money from your parents, etc. But ask yourself a couple questions. This is a little quiz here for you. So how much money should you start with? A, $500, B, $1,000, C, $10, or D, $250? And then how should you make this money? A, given it from friends and family. B, earn it yourself through hard work. C, paper trade, which means trading with fake money or investing with fake money. D, steal it. So this may be pretty obvious. The first one, maybe not as much. And the first one, I suggest starting with $1,000. This is a great starting point. It means that you can buy most stocks, and it may prevent some greed as well. When you're investing with $250, you don't really care as much. You can get a little greedy. $500, you can good, but you can't buy every single stock out there. $1,000 is there is a fractional shares on most things, which we'll talk about later in the video. I think $1,000 is a great starting point. It also shows they were willing and able to put up to $1,000 into the market. If you can put $1,000 into the market, that means you have a job or you're making some money, which I'm going to talk about how to do in a second here. And I think it's just a great starting point. It's also a significant amount of money, which means you're going to prevent greed and you don't care about, you actually care about losing this money. It's not 20 or $100 where you're just going to try and go gamble it away. It's not that big of a deal to you. $1,000 to most people, I think, is a decent amount of money. So if you're just starting, especially as a teenager, I think save up $1,000 and there's a great starting point for investing. How should you make this money? Well, giving it from friends and family. A lot of people just get given money from friends and family, etc. That's okay. There's nothing against that necessarily. But I believe if you earn it yourself through hard work, it'll allow you to become attached to the money, and you'll be more careful, you'll do more research, and you're overall going to become a better investor because it's going to have more meaning and attachment to you. Paper trading's great just to kind of learn some of the basics and how to operate the systems, but you really don't need a paper trade for more than a day or two just to kind of understand how a brokerage works, etc., or maybe just to learn a little bit of how to place orders, etc. But actually just doing paper trading for a long time, I really don't think it's necessary. And again, you're just not going to be attached to the money that you're using, so it's not going to give you the same experience as investing with your own money. And D, stealing it, obviously don't ever commit a crime. That's bad. That was kind of in there as a joke. All right, so best ways to make $1,000. And I have kind of two different ways here. Number one is the easy ways, which will take about a month, I think, or so. Could take less, though. And the more difficult ways, which take 1 to 2 weeks. Now, blue-collar work and simply doing service work on the side, whether you have a job right now and you want to make money on the side, or you don't have anything, you're in high school, and you want to get more. Now, this is especially during the pandemic right now. And if you're watching this and the pandemic's no longer going on or something like that, then don't worry about it. But pressure washing, lawn care, playing an instrument at the farmer's market. I noticed that I used to do that when I was in grade school, and just someone sees a cute little kid playing the trumpet at the farmer's market or just, on the street or something. You're going to get a lot of cash for that. People love to donate and support kids who are hustling like that. selling used items on eBay, garage sales, and also just selling items on consignment during that garage sale. Going around to your neighbors, say, hey, I'm having a garage sale. I'm going to be advertising it. If you have some bigger items that you want to sell, maybe you have some furniture, sell it on consignment, and you can probably easily make $1,000 in a day doing that. House cleaning, just doing random chores, etc., for just quick bucks then and there, and then just putting it aside. Some more difficult ones include roof moss removal, especially if you're here in the Northwest. Gutter cleaning, painting, etc. It's more blue-collar skilled work, but you can definitely do them on the side if you have a normal job, or if you don't have a job, it's stuff that's always in demand. So it's a great way to get into that, and it's really easy to make $1,000 in a couple weeks doing that. You can get jobs by just handing out flyers, or just get a part-time and full-time job and save up from there. That's also an easy way. So now let's just go on to educating yourself. Education is super important when it comes to investing. A lot of people say investing is extremely easy, that it doesn't really take that much. You don't need to go to school for it necessarily, all that. Yeah, you don't need to go to school for it. You can learn it on your own, and if you're watching this video, you're trying to learn it on your own right now, which is a great first step. But there is a lot of things that can go wrong. It is money. It's not, it isn't a joke. You're not just throwing money in, hopefully. If you saved up and worked for $1,000 and you invested it, the case is you probably don't want to lose that money. And let's educate yourself on how to do that. And this video is a great first step, but I'm going to show you some other ways to do it as well. So here's some books, websites, YouTube videos, and talking to those who have already experienced investing or who have experience investing is another way to educate yourself. Some of the best books that people always ask me, they say, hey, David, what's your, what are some things you recommend for me to learn about investing? The first thing I always recommend is to read is The Little Book That Beats the Market. It's a little over 100 pages. I read it in about a night, just one evening. I just sat down, cranked it out in a couple hours or a few hours. It is a fantastic book. It just teaches you exactly how to beat the market every year, how to get great returns in the long run. It gives you exact formula. It talks about some definitions of things, etc. It's also just super short and sweet. Next is A Random Walk Down Wall Street. A lot of my friends read this. It's just a great little intro into investing. The Little Book of Common Sense Investing. Again, just really short and sweet book, not too complicated. Anyone could read this. You could read this if you're in middle school, even if you're in grade school maybe, high school, etc. This is perfect for you if you're just getting started investing, even for any age. It just really teaches you how to beat the market and teaches you the basics. Now, the most popular that you've probably heard of is The Intelligent Investor. It's the book that Warren Buffett said kind of changed his mind about investing and the entire way he thought about it and what led to him being a successful and intelligent investor. One that goes along with this is Security Analysis, and these are both by Benjamin Graham, who is Warren Buffett's mentor. You definitely know Warren Buffett, probably. He's a famous value investor. Benjamin Graham was his teacher and mentor. So anyways, Intelligent Investor and Security Analysis. These are great books to read, but they're big books. They're really difficult to understand. Most people read them because they think that that is how they're going to learn how to invest. And it's great. I think you should read it, but if you're going to read those books, just know you're probably going to have to read it more than once. And if this is the first book you're reading on investing, I don't recommend it because I think there's a lot of technical terms. It can be a lot of information. It's a little complicated. So if you already know about investing, you're already kind of getting into it, then it's a great read. But otherwise, I would suggest holding off until you read some of these other shorter books, some of the ones that are a little more simpler, just to get some of the terms down, to just understand some of the basics, and then read that later on. You could even read that later on after you've started investing, but they are great books to read. And Beating the Street is another one. Some investing-related books that I think are just super interesting and can teach you a lot about the market and finance in general is The Millionaire Next Door, When Genius Failed, which talks about the 2008 financial crisis. Or no, that's Senseless Panic, talks about the 2008 financial crisis as well as the savings and loans crises to tell you kind of what went wrong there. And When Genius Failed also just kind of tells the tale of that you don't need to be a mathematical genius to be an investor. I'll tell you right now, I am not very good at math at all, but I know more about investing than the majority of my friends who are engineers, who are going to school for, major science degrees, etc., and are pursuing a lot of these things, who are very mathematically oriented. They're not always the best investors. And in fact, When Genius Failed, it almost led to the complete collapse of the financial system because they were thinking so mathematically, they almost messed everything up. All right, so just a really interesting book there. Some websites. Investopedia is great, just for definitions. If you need a term, if you need a definition of something, Investopedia comes up. It's great. Hypercharts.co. This is by my friend, or he's not really my friend. I don't really know him very well, but I watch his YouTube channel. He's great. It's Gally on Hyperchange is the YouTube channel. I highly recommend watching his YouTube channel. But the website that he co-founded is hypercharts.co, and it just displays financial information of companies, which will help you later on for analyzing stocks especially. And it just does it in a very simple and easy to view way. So for beginners, it's a great thing to look at. I use it all the time on displaying graphs and stuff on this channel. The way they display information and data is really straightforward, and it's a great site. Yahoo Finance and Google Finance just give you the basics, and they're just great for looking at just kind of an overview of the company. Brokerage accounts, Vanguard especially, have lots of educational centers, etc., right in your brokerage account, and we'll talk about brokerage accounts in a second here. Forums, Reddit. So my favorite one on Reddit, and these are forums, you got to be careful. I put be careful next to StockTwits and Twitter. So this is because there's lots of opinions. Opinions are great. It's good. You can get tips on different stocks. You can get information. But there's also a lot of people trying to pump and dump stocks, which means they're trying to get you to buy the stock in order to artificially inflate the price due to increasing volume on that stock by trying to say, oh, look at this company. It's so good. They're going to do this and this and this. And they already own a bunch of shares. But when they get all of you guys to go and buy the stock, it increases the stock price. And then those guys sell it and the stock price crashes and you lose all your money. So it's kind of dangerous. Just be careful on these opinion sites, especially these forums. I like Wall Street Research because rather than just people spamming videos, etc. on Reddit, they really do full-blown research. I've actually gotten some companies from there that I would not have ever noticed otherwise. Just make sure you always do your own research, and I'll show you how to do that later on. So YouTube/opinion sites. Joseph Carlson is a great podcast to listen to on dividend investing. Hyperchange, as I said. StockerFinance, my channel right here. Make sure to subscribe and check the rest of my videos out. Khan Academy actually is a fantastic investing and finance series on YouTube. Warren Buffett, Charlie Munger, and Peter Lynch. There's tons of old video clips of them talking on YouTube. They're awesome to watch. The Motley Fool is a great site. It's definitely opinionated, but some of their recommendations, some of just their analysis on stocks can be really great. I trust them a lot more than some of the other sites. They just have some good insight on different companies, etc. But they are very opinionated, and a lot of their writers also hold shares in the stocks that they're writing about. So just make sure to scroll down to the bottom or the top and check the disclaimer to see if the author of an article that's writing on the Motley Fool or any of these sites actually own shares in the company, since they have to disclose that, which means they might be biased. Market Watch is another just great one for general finance and investing news. All right, opening a brokerage account. This is probably what you've really come here for, is to how do you get started? Opening a brokerage account is the first thing. And let's talk about which brokerage is the best and which one should you use. So here are my top choices. We got Robinhood, TD/Charles Schwab, Vanguard, and M1 Finance. You may have heard of some of these names. You've probably heard of Robinhood especially. In my opinion, Robinhood has a lot of criticisms, but it's also great, and I think it's best for beginners and people who just want to invest a small amount of money, or as I said, just $1,000, the initial $1,000 on your phone. It's great for app users, etc. It's just super simple to use as well. TD/Charles Schwab. This is really great customer service. 24/7. It's awesome. Robinhood lacks some of that customer service. It's great for people who want to more actively trade rather than do long-term investing. And it's just more advanced in general. The platform's super established. Vanguard. This is best for retirement accounts. It's a great education center. Tons of indexes, etc. So for retirement accounts or things that you're going to be holding till the end of your life, Vanguard's great for that. The fees are also super small. M1 Finance is a relatively new brokerage account, but it's great for dividend investing. They display your account in a pie chart, and you can adjust it based on fractional shares. Fractional shares means that if there's a stock that costs $1,000, you can only buy a slice of that. So you could buy 0.25 for $250. When a lot of these brokerages, you're not able to do that. You have to have $1,000 to buy a share of that stock. So that's what's great about M1 Finance. It's also great for just long-term holding as well. So how to open an account. Number one, you're going to go to the brokerage's website. It'll either prompt you or you can click register account. This is pretty much the same for all of them. You can set up an account on every single one of these in basically a couple hours or an hour, even less than that. Robinhood takes like 30 minutes. You'll click register an account. Now follow the instructions. It's going to ask you for your social security number, your address, your full name, your investment experience, your age, and other sensitive information. Then it'll ask you to link your bank account so you can deposit funds. Robinhood does a thing where it'll deposit funds right away for you, up to $1,000, I believe. It'll deposit right away and you can start investing immediately. And then once your funds go in, it'll transfer over. It's just super cool. A lot of brokerages have been doing that, so you don't have to wait a few days before investing. If you're under 18, however, you're going to have to open a custodial account. Otherwise, make sure you open a singles account. A retirement account is also called a Roth IRA if you're interested in opening one of those. If you're interested, or if you're under 18 and you want to know how to open a custodial account, I highly suggest checking out my videos on investing for teens. Right now, it's the most popular video on my channel, how to invest for teens. Go check that video out and it'll help you substantially. So next out, starting to invest. So you've gathered capital, you've educated yourself, you've now opened a brokerage account, you deposited funds in that account. Now what? This is just the beginning. Well, first, you need to understand the different types of investment instruments. So what are investment instruments? These are just different things you can put your money into. You can buy shares of, you can whatever it is. So stocks, bonds, index funds, mutual funds, currencies, and futures. There's plenty of other investment instruments as well, such as CDs, a bunch of different things that I'm not really going to go over because there's not as popular. But for a beginner, these are some of the most popular ones that you're going to hear about a lot, especially in the news, especially that your brokerage are going to offer, etc. So what are they and how do they differ? Well, let's start off with stocks. Here's a brief description of what a stock is. So when you buy stocks, you own part of the company's assets. If the company does well, you may receive public dividends or periodic dividends, which are generally quarterly, and or be able to sell your stocks at a profit. If the company does poorly, the stock price may fall and you can lose some or all of the money you invested if the company goes bankrupt. So this is the most common type of investing you're going to hear about. I personally choose to invest in stocks over any other investment type due to the choices it allows for and the potential for very large returns. Stocks go up in value based on the company's performance and growth. So if you're investing in a stock, you want to make sure you're investing in a company that's performing well and will be growing in the future, not shrinking and etc. in the future and not doing well. They may fluctuate day to day, but the long term should continue growing in price if you choose a right company. And I'm going to show you how to analyze and choose a great company later on for buying stocks of. So now we'll talk about bonds. A bond is a certificate of debt issued by the government or a company with a promise to pay a specified sum of money at a future date and carries an interest at a fixed rate. Bond terms can range from a few months to 30 years. Bonds are tradable instruments and are generally considered safer than stocks because bondholders are paid before stockholders if a company becomes bankrupt. Independent bond rating agencies rate the likelihood that any given bond will default. And there's tons of these websites out there that do that for you. One of the safest instruments is the U.S. government bond, since you only lose all your money if the U.S. government collapses, which most likely won't happen. So your money's very secure with U.S. government bonds. Bonds usually won't give the same return as stocks will, but they minimize risk significantly. Warren Buffett says he has 90% in stocks, 10% in bonds. However, some recommend more bonds the older you get, such as having maybe more like 70% in bonds and 30% in stocks if you're retired and just want to see some interest on your money, but you want to minimize the risk. Bonds are great at minimizing risk. So now let's talk about index funds. Well, an index fund is a mutual fund or an exchange-traded fund designed to follow certain present rules so that the fund can track a specified basket of underlying investments. So it's just a collection of a bunch of different stocks, essentially, or a bunch of different investments. There's tons of investments or index funds. They tend to be lower risk since index funds are more diversified. You can choose certain funds that are specific for a sector or certain outcome. So there's dividend funds, high yield dividend funds, which focus only on companies that have great dividends. There's tech funds that only buys tech stocks, real estate index funds, which only buy real estate companies, banking, etc. There's one for pretty much every different sector, every outcome you want, slow growth, fast growth, more risk, low risk, etc. And they're great to have in your portfolio if you want to further diversity or lower fluctuation. Or if you're just not comfortable picking an individual stock and you're just not really sure how to do that, you can go ahead and pick an index fund based on the market that you're interested in instead. So if you think the tech sector is going to do great, go ahead and buy some tech-heavy index funds if you're not comfortable going and deciding which specific companies to pick. So now, mutual funds. Mutual funds is a professionally managed pool of money from a group of investors. So an index fund is just a collection of stocks, and mutual funds are managed by a group of investors. Key difference there. A mutual fund manager invests your funds in securities, including stocks and bonds, money market instruments, or some combination of these, based upon the fund's investment objectives. You could have a long-term retirement account for mutual funds. You could have one that's high risk, etc. By investing in a mutual fund, you can diversify, thereby sharply reducing your risk. Most mutual funds charge fees. You often pay income tax on your profits. And that's something that you have to be careful about. So most mutual funds are great, but there are some who the person managing your pool of money simply just wants to collect those fees. And they don't necessarily want to grow your money because they don't want to take your money out. Their job is to protect your money and get you to invest more money so they collect more fees, not necessarily care about growing your actual pool of money. So be careful who is choosing your investments if you have a professional doing it for you. Currency. So investing in currency involves buying the currency of one country while selling that of another. So you're buying a currency against another one. For example, the US dollar to the euro, or the US dollar to the peso, or whatever it might be. You're just selling and buying currency against each other. This is done through the foreign exchange market, also known as Forex. Forex trading always happens in pairs, as I just talked about. US dollar to euro, etc. You're just trading them back and forth. So if one day the US dollar is valued at, I'm just going to give an arbitrary example, by the way. This example is not going to be accurate at all. Is worth $1, and the euro is worth 99 cents in US dollars, then you can buy the euro, and if the euro goes up to $1.02, well, you just made 3 cents on each euro you own when you trade it back to US dollars, if that sort of makes sense. Kind of a weird, complicated thing. One thing I want to say is that you're going to see a lot of ads on YouTube, a lot of people advertising Forex trading, how to make money quick. Ignore all that. Do not, I repeat, do not buy any lesson or any course, etc. All the information you need on investing, on currency, on any of these financial instruments is all on YouTube. There's tons on my channel completely for free. There's tons of it on Khan Academy, as I said. There's tons of ways to learn about investing. You do not need to pay for anything. You can read books. The only thing I'd say you should pay for is if you're buying a book, because a lot of books give fantastic information. But again, be careful about which book you buy. I suggest buying a lot of the books that were written a long time ago or have great reviews, because those ones are going to be the better ones, especially if they're more traditional and about traditional investing techniques, etc. So let's talk about cryptocurrency really quickly. You've probably heard of it. I don't mind cryptocurrency. Has its doubts, has its whatever it may be, but I've realized it's very easy to start gambling with cryptocurrency and not investing when crypto is involved. The prices fluctuate a ton. They're kind of unregulated. You're not investing in a real object like a company. So when you invest in a company, you're actually buying a share. You get a vote in that company because you're actually a shareholder. If you buy a share of McDonald's, you can say, hey, I'm a partial owner of McDonald's. It's pretty cool. Every profit that McDonald's makes, you get a tiny, tiny little piece of because it's paying you a dividend. Cryptocurrency does not do that. It's its own thing. Again, it's just a currency. And unlike a currency that is backed by the US, etc., it's kind of its own thing floating around. Anybody can create one. There's a lot of great things about cryptocurrency, don't get me wrong, but just be really careful and tread lightly when you're going into that. So now let's talk about futures, our last financial instrument we're going to talk about here. In finance, a futures contract is a standardized legal agreement to buy or sell something at a predetermined price at a specific or specified time in the future between parties not known to each other. So someone is selling a gallon of oil and they say, and you buy the rights to purchase that gallon of oil at let's say $10 or $10 for that gallon of oil at whatever date. And what I'm saying is just a broad example. It's not true at all, or it's not accurate at all. So your hope is that when that date comes, the price of oil is higher than what it is. So you just bought oil and you made $5 because you get to buy it for $10, even though it's now worth $15, whatever it is. The asset transacted is usually a commodity or financial instrument. For example, oil futures, there's like soybeans, there's cattle, there's a bunch of different things. If you can't sell the future at predetermined price / time, sometimes you might actually have to take delivery of the commodity. This happened recently with the oil markets, or the oil futures. So futures can be to diversify your portfolio, but you do need to be a little careful about it. However, they're a great way to diversify your portfolio, especially if you're buying like gold futures, etc. So decide what you want. Now we're going to talk about investment strategies. And now you've understood, you've done your education, you've opened your account. You need to say, what is my goal? And you need to ask yourself some questions. Do you want a fast return? Do you want to create long-term wealth? Do you want consistent income every month or so? Do you want to keep your money safe? These are things that you need to decide. Well, there's a catch to every strategy. If you want a fast return, there's generally going to be more risk. Do you want a long-term wealth creation? Well, it's going to take a long time. Do you want income? Where you're going to need a significant amount of capital to create that income. Do you just want to keep your money safe? Well, that probably means a very low return. So there's a catch to every different strategy. So here are the most popular strategies. Value investing, which is Warren Buffett famously kind of champions. Dividend investing, growth investing, buy and hold, high risk, high reward investing, and the triple threat strategy, which is my personal strategy, which is a combination of these. So first off, let's talk about value investing. Value investing is an investment strategy that involves picking stocks that appear to be trading for less than their intrinsic value. An intrinsic value, all that is what you think the future value of a stock is. So if you believe, let's say, Apple is worth $500 a share, but it's currently worth $300. Well, that means there's $200 for you to gain there. Since you believe the price is $500, it's currently undervalued at the $300 mark it's at. That's a really brief, kind of broad example. Take that kind of with a grain of salt there. But I think that's a decent example just to show. So value investors actively seek out stocks they think the stock market is underestimating. Warren Buffett is a value investor. The pros to this is it creates long-term wealth, potentially high returns, buy and hold. Can go along with other investing strategies. It's effective in a simple strategy. Requires patience though. Situations can always change. It can be hard to find undervalued stocks. Knowing what's undervalued, you can say anything has an intrinsic value, but is it really worth that much? How do you know what the intrinsic value is? That's something that's really hard to tell. So there's no room for emotion in this, and intrinsic values can be difficult to estimate, as I said. Next one, dividend investing. So dividend investing is a strategy of buying stocks that pay dividends in order to receive a regular income of your investments. The income is in addition to any growth that your portfolio experiences as the stock in it gains value. If you want more information on dividend investing, I highly suggest you listen to the Joseph Carlson podcast or his YouTube channel. You can watch that as well. He is a dividend investor and he makes great videos on it. It's long-term wealth creation. It creates consistent income. It's a buy and hold strategy. It's a growth of companies that complement the dividends. So as you receive dividends from those companies and you're receiving money for your investment, well, the company might also, or hopefully will also be growing, and you're going to earn money on that. As well as compound interest. As you reinvest those dividends, you're going to be creating compound interest. If you don't know what compound interest is, or if you don't know what dividends are, pause this video. Go ahead and look up what is dividend investing or what are dividends. Just a quick Google search, you'll find out. Should be on Investopedia or any of the sources that I previously talked about, you can find out. I also suggest you look up a compound interest calculator, fill out the calculator, and just see how powerful it is. This is one reason Warren Buffett is worth so much money today and why he is so successful, because he bought and hold, he received dividends, he reinvested all of those dividends or most of them, and it compounded. And that's why he created most of his wealth in the later years of his life, not early on. The cons to this is it requires a lot of patience. Those dividends can change, companies can decrease. If something goes wrong with the company, it could cut its dividend. No room for emotion. It takes a lot of capital to receive substantial income. If you invest $1,000 that you start with, you're only going to be receiving maybe a couple bucks on that $1,000, or maybe $10 to $20 a year, etc. Maybe more than that. Maybe you might be receiving $100 or something like that, which is 10% return. That's not bad. But for you to really receiving a livable income, like let's say, $1,000 a month or something, you're going to need a lot of money. So through compound interest, you can get there, and through reinvesting your dividends and the value of the companies you're invested in increasing, but it is going to take a lot of time for that to happen. So next up is growth investing. Now, growth investing is an investment style and strategy that is focused on increasing an investor's capital. Growth investors typically invest in growth stocks, that is, young or small companies whose earnings are expected to increase at an above average rate compared to their industry sector or the overall market. You might have heard the name George Soros. He is a growth investor. There's plenty of other growth investors out there as well. The pros to this is long-term wealth creation. There's potentially very high returns. It's more active trading in general. It's a little more entertaining. So there's faster growth as well. Hopefully you are beating the market, not just matching it. The cons require patience, have higher risk. It can be very volatile. There's no room for emotion because you really have to ignore a lot of that volatility, or you could really get caught off guard. It can be hard to find great growth opportunities companies. Everyone's trying to find the next big growth company, the next big Amazon, the next big whatever it may be, and it can be very difficult to find those. But I promise you, there's tons of them out there. They come out, there's lots of these companies every year. New companies are IPOing all the time, which is an initial public offering, which means they allow you to purchase shares of them. So it can be very hard to find, but it is possible, and growth investing is great. No, buying and holding is literally just what it is. It's just buying and holding a company. It's also called position trading. It's an investment strategy where investors buy stocks and holds them for a long time with the goal that stocks will gradually increase in value over a long period of time. You're just ignoring all those daily fluctuations, all that daily news. You realize that this company has great financials, that it's going to be really good in the long run. The products it's creating are selling great. A lot of these companies that you buy and hold for a long time might not be super exciting companies. They might be kind of boring, but hey, they're going to give you dividends, or they're going to just grow over a long period of time. It's a boring strategy, but it's very successful. Benjamin Graham is a growth investor. He's also a value investor and dividend investor. Pros: long-term wealth creation, consistent returns, diversified, not worries about market fluctuation. Basically, you're just not going to be worried. You're going to ignore those fluctuations. Applies to almost every sector. The cons: requires lots of patience, lower average returns because it's less risk, generally means not as high a return. Very volatile. You have to stomach the downturns, and it can be quite boring, to be honest. A lot of people like the excitement of buying and selling. All right. High risk, high reward investing. So high risk investment is therefore one where the chances of underperformance or of some or all of the investment being lost are higher than average. These investment opportunities are often offer investors the potential for larger returns in exchange for accepting the associated level of risk. Michael Burry from The Big Short, which I highly suggest you watch that movie, The Big Short, it's great, is a high risk, high reward investor. He made a very large bet that the market would collapse. He was shorting the market, which means he was going to make money as the market went down in value, or as that company's stock prices went down rather than up. If you want to know more about what short selling the market is, go ahead and do some research on that. Just type in short selling, what it is. However, I don't suggest when you just start out investing, and this is the reason I didn't put it in this video, I really don't suggest you start out by short selling, because although you can make money, it can be great, you can also have an infinite amount of losses, since a company's stock price can go infinitely upwards, but it can only go down to zero. So you can only make as much as the company can lose, but you can lose as much as the company can goes up, which is potentially an infinite amount. The pros to this is it could create long-term wealth creation, and that is something that you've probably seen throughout this. Nearly all of these could create long-term wealth creation. That's the beauty of investing, is that this goal is to create long-term wealth creation. It's potentially large returns. You have to seek out opportunities, which some people just enjoy, and it's fun to do. Takes advantage of market fluctuations, shorter periods of time. So if you have an eye for seeing little fluctuations, or you watch the news a lot, if you're really good at noticing something going wrong, or if you're good at predicting the future, potentially, then high risk, high reward may benefit you. The cons to this are it's very high risk, it's very volatile, you can't have any emotion involved, which you may have noticed is also a pattern in this. Emotion and patience are both patterns throughout all these strategies, because emotion can take over. And there's so many times where someone buys a stock, it's a great company, they're going to do really well, but there's some bad news, and for some reason the stock goes down a few percentage points. And next thing you know, they sell, and then a year later the company's at an all-time high, and they missed out on that huge opportunity. So you really can't have emotion, but you need to be logical. You need to have patience, and there's extreme uncertainty with high risk, high reward investing. And now we're going to talk about the triple threat strategy, which is my personal investing strategy. I'm just going to briefly go over this. So, an investing strategy that combines value investing, growth investing, and high risk, high reward investing into one. Triple threat investors seek out larger returns in shorter periods of time, but make bets on companies that are okay with holding for long periods of time. So I'm trying to see large companies that have something wrong. The pandemic is a great example. There was a massive downturn in the market. It went down like 30% within a couple days. A triple threat strategy person would go in and buy up a bunch of those companies, but it wouldn't go and just buy any companies. It would look at companies that is comfortable holding for long periods of time. For example, Apple, when it stumbled down a ton, or Intel, or Starbucks, or Disney, all these different companies that really got hurt by the initial downturn of the market. But if something were to happen, whatever, I'm okay with holding these companies for long periods of time, because I know that they'll recover eventually, that they give a good dividend, etc. So it's kind of a combination. The point of this And I am a triple threat investor and strategy investor. But the point of this is that you can choose and combine more than one strategy. Example, Warren Buffett combines dividend investing, value investing, and buy and hold investing. It's great to combine more than one of these. All right, how to choose a stock. So that comes down to three things that I've tried to summarize how you can choose a stock: intrinsic values, health of a company, and the potential for growth. So the intrinsic value of a company is, as I said, what you think the future value may be. The health of a company, is it financially healthy? Does it have a tons of debt? Is it profitable? Is it making money? Will it make money in the future? Is it growing? Is it getting more customers, etc.? As long as the company is a very healthy company and it has a lot of potential for growth, so the market it's in is doing really well. If it's a shrinking market, you probably don't want to be in that, or you might not want to choose the stock to invest in. Dividends may also be a factor for you if you're a dividend investor and you want to receive income on your investment. Maybe look at the dividend rate. So a way to do this is through stock screeners. Stock screeners allow you to enter in information and to do research on certain types of companies. Also, just word of mouth, news, forums, etc. are ways to find them, but always make sure you do your own research. So, conducting your own research, let's talk about this and how to do this. You always want to conduct your own research, although comparing can be good. I always hear people telling me about different companies that I should look into, or hey, I think this company is going to do really well. That's great. You can see that all over the internet, or people can talk about it to you. You want to take that. You want to take that company, and then you want to go research it on your own and see if it's true, if that company is a really good investment, or if maybe they don't really know what they're talking about in this company, or maybe they have their own self-interest and this company really ain't that great. All right, guys. So I want to do a quick stock analysis. Now, first we're going to look at McDonald's Corp, and I just want to help you understand all the information going on around here. So here we have the one-day chart. As you can tell, the price fluctuates, not very much. We have the 5-day, the 1 month, 6 month, year to date, 1 year, 5 years. This is kind of where the pandemic happened. As you can tell, it hit that day, February 21st, and it stumbled about 30% downwards over the course of a week, or about a month, actually. It was pretty drastic, but the stock has since recovered about 30%. Now, a lot of this, the problem is, if you go to the max here, let's look at 2008. Here is 2008. You can hardly tell anything happened during that. And that's largely because McDonald's was unaffected. But a lot of these companies, if you bought at the bottom of 2008 or if you sold there, well, if you just held on over time, you'd be up a substantial amount, over 200%. So that's one thing that buying and holding and just stomaching these little downturns is super important. Because although you may feel the news may be telling you to sell your stocks, etc., if you believe and you know that your company is great, which I'm going to show you how to tell if this company is great, then you're going to do well. And you might just want to hold on and not worry about it. Or maybe you might even want to buy more and average your price down. So we have the high for the open for the day, which is the price that the stock opened out. We had the high for today. So the high today was $186.44 per share. The low was $183.72. The market cap. Now what the market cap is, it's the number of shares times the price of the shares. And so for McDonald's, it's worth $137.31 billion. That's how much the coal company is worth. The PE ratio is 24.19. The PE ratio is price to earnings, so how the price reflects its earning. So right now, its price is 24 times its earnings, which is pretty average for companies like this. If you see companies who have 200 PE ratios or 2,000, it depends on the sector, but sometimes this can help you choose whether a company is undervalued or overvalued. You can look at that 52-week high, how high the stock price was over 52 weeks. If you're buying at the 52-week high, sometimes that can mean, maybe I'm buying at the very tippity top. But also it might not matter if you think the company's intrinsic value is higher. It has a dividend yield of 2.71%, which means for every share you own, it's going to pay you 2.71% of $184.66. It usually will do that for 4 quarters of the year. And has a 52-week low of $124.23. All right, so now I want to talk about this analyst report and how I do my analyses. So if you're going to be researching a company, you need to do a few things. Here's one for Tesla that I did back in 2019. The first thing you want to do is go through and just get its quick, financials right here. You want to find out the current price, what you believe the intrinsic value might be. And intrinsic value is hard. I'm going to make a whole separate video about how to estimate that. The 52-week high, the 52-week low, just some basic information that I just showed you. And then you want to find out what you think. So recommendation, long-term buy. And this was when Tesla was worth $211, which is pretty crazy. It's now worth about $1,100 per share. My intrinsic value was only $350 at the time. That's pretty crazy, actually. Then you want to give her a little report here. And this is a really long analysis, but for you, I suggest just writing up a little report about why you think the company's great. Is it experiencing rapid growth? Tesla's experiencing technology innovation because they were competing. Then you want to do some research and you want to give a description of what they're selling. You want to understand and know the company you're investing in. You don't just want to be gambling into something that someone told you to do or into something that you don't fully understand. You want to have a research report on exactly what you're investing in. How's the industry? Oh, the industry's growing substantially. That's great. You want to know, how does it stack against its competitors? Oh, look at this. Tesla was top 10 U.S. plug-in cars as of, or Tesla's Model 3 was, as of March 2019, January through March 2019, apparently. Here you can see that the Tesla Model 3 is growing substantially compared to other cars. So you want to have all this. You want to look at the growth and where it might be going in the future. So here you can tell how it's doing over time, that it's growing over time in terms of, what are these, deliveries, I think? Oh, these are sales growth. So it's just you want to get into the financials. You want to get into everything. Here's SolarCity, another sector of Tesla. Now this is a massive report for Tesla. You do not need to do this, but I highly suggest just writing up a 2-page report or a 1-page report on why you think this company will do good. By writing that report, it's going to force you to really make an understanding of what you're actually investing in, and that'll be extremely important for you to understand the company and to either confirm your belief in that company or not confirm it and say, maybe this company isn't so great. But if it is, then you just did a report and you know now that if there's a little price fluctuation, if something bad happens in the news, well, you know what? I have my report. It says this company's growing. It says it's doing well. I'm sticking with the report on my own research. I think this company is going to do great. It's still profitable, despite maybe, whatever, besides the CEO having to step down. It's not going to be that big deal. They're going to hire an even better CEO, or they're going to hire another one, blah, 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 blah. So that is kind of just a quick, brief example of a stock analysis. My point of this whole thing was just to say that you really got to do your own research, and you really just got to make sure that you understand what you're investing in. It's not just a joke, it's not just a random thing. You want to know and understand the company you're investing in. You want to be able to pitch to someone why you're invested in the company that you're invested in. So now let's talk about types of trade/orders. The bid and ask prices are stock market terms representing the supply and demand for a stock. There's the bid price. The bid price represents the highest price an investor is willing to pay for a share. There's the asking price. The ask price represents the lowest price at which a shareholder is willing to part with shares. We're willing to sell his shares at. So first we have a market order. This is a trade order to purchase or sell a stock at the current market price. A key component of a market order is that the individual does not control the amount paid for the stock purchase or sale. The price is set by the market. A market order possesses a high slippage risk in a fast-moving market. So that means if you place a market order and the price is $100, well, by the time that order goes through, if for some reason the stock randomly flashes to 95, you might have either bought or sold that stock at 95 instead of the desired price, which you thought was $100. So that is one problem with market orders, is the price can move around while your stock is going through, and it can execute ahead of yours at a completely different price than what you thought. Usually it's not that big of a difference, but if a stock is falling rapidly or rising rapidly, it could definitely be a big difference for you. For example, if an investor places an order to purchase 100 shares, they receive 100 shares of that stock at its asking price. Limit order. So limit order is a trade order to purchase or sell a stock at a specific set price or better. Prevents investors from potentially purchasing or selling stocks at a high price. So this, rather than market orders, which is just selling at whatever it's at currently, this will sell at a specific price. You can say you want to buy a stock or sell a stock. Let's say you have $100. Let's say a stock is worth $100 right now. You do a market order, it's going to sell around that $100 mark. But you don't think that's a good price to buy it at. You want to wait until it dips down to $90. You can set a limit order to buy the stock or a number of shares at $90. If the price hits that $90 mark, then it'll execute and you will receive $90, or you will receive however many shares you want at that price. In a limit order, if the market price is not in line with the limit order price, the order will not execute. A limit order can be referred to as a buy limit order or a sell limit order. So again, a buy limit order is a buyer and specifies that the buyer will not pay more than whatever the amount of money is per share, with whatever amount of money being the limit order set by the buyer. Example, consider a stock whose price is $11. An investor sets a limit order to purchase 100 shares at $10. In this scenario, only when the stock price hits $10 or lower will the trade execute. A sell limit order is used by a seller and specifies that the seller will not sell a share under the price of whatever it may be per share, with whatever it may be being the limit order set by the seller. An example, consider a stock whose price is $11. An investor sets a limit order to sell 100 shares at $12. In this scenario, only when the stock price hits $12 or higher will the trade execute. Now we're going to talk about a stop loss order. This is designed to limit an investor's loss on a position. A stop order sells a stock when it reaches a certain price. Although a stop order is generally associated with a long position, which means you are bullish on the stock, you want the stock price to go up, it can also be used with a short position. In that case, the stock will be purchased if it trades above the stop order price. An example, investor Bob is considering selling his stock if it declines to $8 from its current price of $12. The investor could place a stop order at $8. When the stock hits $8, the order would be executed. A big thing here. So if you place a limit order at $8 versus a stop order. A stop order, if you place a stop order for $8, if the stock hits $8 or when it goes near that, the order will be executed. But it might not sell exactly $8. A limit order, though, will only sell exactly $8. If the stock never is exactly $8, then it might never happen. So, the stock will not necessarily, and this is great for keeping emotion out of investing and preparing for uncertainty, because you can relax and say, okay, even if the stock goes down 20%, it'll sell and I'll be comfortable. This is especially prevalent if, let's say, you're up a bunch on this company. It's doing fantastic. You're up 20%. Well, you don't want to lose these gains if something tragic happens, like a recession or random pandemic. You want to put a stop loss order in to prevent that from happening and to be confident that you're still going to have a nice return on your money if the stock market were to randomly crash. So it will not sell exactly $8, depends on the supply and demand for the stock. If the stock price is rapidly falling, the order may be executed at a price significantly lower than $8. This type of problem can be minimized by a stop limit order. Selling and understanding when to exit. Don't feel obligated to sell at a certain price or time. Buy the fear, sell the greed. The fundamentals don't match the price or it's overvalued. So the most important thing to remember is that you can average down and that if you're playing the long game, daily fluctuations don't matter. You don't need to look at the price changing a few cents a day or a few dollars a day. That doesn't matter. If you're confident in your company, you've done your analyst report, you've bought in shares at whatever price, and you have come to the conclusion that this company is worth more than it is, or if you don't know what it's worth in the future, you at least know this company is going to be growing and that the market it's in is growing, that it's producing good products, you like the management of the company, etc., then why worry about the daily fluctuations? You're confident in this company, you know it's great, there's no reason to get emotional and worry about the daily fluctuations. And if you believe and you've done a proper analysis, then again, why worry about random negative news or volatility? One thing I want to say, though, again, is go over these top 3 different things. Don't feel obligated to sell at a certain price or time. A lot of people say, if I get 20%, I'm going to sell. Why? Why put a limit on you? Instead, you could wait if it goes up 20%, or if it goes up 30%, you can go ahead and place a stop order at 20%, so that you'll always receive 20%, or hopefully you will. And it will take some emotion away. You shouldn't feel obligated to sell your stock at a certain price or time. It is okay to hold for long periods of time. Buy the fear, sell the greed. When people get greedy, they tend to not know what they're doing and make rash decisions. They can cause the market to, go out of control. It can cause companies to be overvalued. Bitcoin is a perfect example of something where everyone is buying Bitcoin. It went up an insane amount to $20,000. During that time, I made a video and I said, be careful, guys. Be really careful. I was like, my grandma, my random friends in high school at the time were coming up to me and saying, hey, David, are you buying Bitcoin, dude? I just bought a bunch. You should. It's going to be so good. And I'm like, dude, you don't know what you're talking about. You've never invested in your life. Why should I believe you? And sure enough, Bitcoin crashed significantly. And that happens to companies all the time, not just Bitcoin. That happens all over the place. People get too greedy, it gets overhyped, and people just don't know what they're doing. If you want to buy the fear, though, for example, the pandemic, the stock market tumbled out of control. Recessions can be the best time to buy companies. If the fundamentals and the underlying company is fantastic, then why worry? You don't have to worry. You can, in fact, buy more and take advantage of that and increase your return. The fundamentals don't match the price or it's overvalued. So if, let's say, a company's worth $1,000 a share, the PE ratio is super massive, so it's whatever it is, 100 times its earnings. That seems a little weird. You look into it, it's, worth 100 billion, but it's only making a couple million a year or something. Wait a minute, that doesn't really make any sense. How can a company that makes a couple million a year be making 100 billion? Or maybe it's losing money and it's really struggling in debt. It shouldn't be worth anything. Then maybe the fundamentals don't match the price and it could be extremely overvalued. A lot of people don't realize something's overvalued, but you should definitely take a look, and that'll, help you avoid some of these companies. And so that is knowing when to sell, or at least having some understanding when to exit. It's very difficult, but if you're playing the long game, then selling should be the least of your worries. You should be able to be comfortable holding this company. Now I want to talk about some of the best investing advice I've ever heard. So first off, invest in what you know and you will succeed. This is a theme I've been talking about through this entire video. It's a Warren Buffett quote that he said, "Never invest in a business you cannot understand." This is incredibly true, and you want to take this to heart. If you've done an analysis, if you've done the company, or if you've done research on the company, you understand that whatever asset you're investing in is solid. You think the stock is below the value it should be at because you've done all your own research. You understand that company in and out. You know who the CEO is. You know what they're coming out with, that their deliveries for vehicles are going to be great in the future, or whatever it may be, then that's a great company. But if you're just investing in a company and you have no clue what they even make or what they do, that's not a good investment. Invest in what you know, though, and you will succeed. Otherwise, it's borderline gambling. Don't listen to others. Form your own opinion. Another theme throughout this video. People love to judge, think they're always right. They love to be cocky, or they always want to be, oh, look at me, I know everything. Be very careful about that arrogance. You really want to form your own opinion. Take what they say. Take the company that they recommended you. Say, oh, okay, thanks for the recommendation. But then go and compare it, do your own research, write up your own report, and create your own opinion of that. When you invest, feel as if you've already lost the money. Every stock Warren Buffett buys, he says he plans to hold forever. When I invested my first $1,000, my parents said, "Dave, are you sure you should do this? I don't know. This doesn't seem like a very good idea. You don't really know what you're doing yet." I said, you know what? I don't care. I'm going to pretend I've already lost this money. They didn't want me to be devastated if I did lose the money. And, well, because I felt that I've already lost the money, it's in the market, I wasn't planning on ever taking it out, it was a lot easier to not get emotional and to not make rash decisions. It's important to be attached to the money and earn it yourself, I think, because it'll, again, help you make those rational decisions, not just gamble it away. But you want to feel that you've lost it. You don't want to get overly protective, overly emotional, and not take, risks or not miss opportunities that might be right in front of you. So you don't need to be right every time. This is incredibly important. This is one of these last two are the biggest pieces of advice ever that I've received for investing, and they have made me a successful investor. Just these last two pieces of advice. Honestly, all of these though. The last one, or the second to last one here, you don't need to be right every time, only once. It's easy to get caught up in the news and and volatile stocks, or the next big thing. There's news every day. There's companies IPOing every day. Every year, there's tons of companies that go public. There's tons of stocks that go up, 100%, 50% every single day. You don't need to be right. Do not get greedy. You will lose your money. All right? Do not get greedy. Avoid that greed. You don't need to be right every time. If you triple your money once, that's an insane return. That's ridiculous. If you get 100% a year, that's crazy. Most people are only trying to get 20%, only trying to get 10% on their money a year, or just trying to match the market and grow their money. So don't get greedy. You don't need to be right every time. You only need to be right once or maybe a few times to really make a substantial amount of money or a substantial return on your money. Be fearful when others are greedy and greedy when others are fearful. Again, I just touched on this a little bit. Greed can lead to losses and not thinking clearly, but you can both suffer and take advantage of this. If you get greedy yourself, you can suffer immense losses because it's going to cloud your judgment. But if you realize that other people's judgment is clouded, that they're selling a company who's fundamentally doing fantastic, go ahead, buy shares, take advantage of that, and in the long term, you're going to benefit from their loss. All right, so anyways, guys, I know this was an extremely long video. Thanks for watching. If you have any questions at all, I know this was kind of a summary, a brief overview of investing. There's so much to it. Feel free to follow me on Twitter and tweet any questions at me or comment below. I'll respond to every question down there. Yeah. Thanks for watching. Please subscribe. I'm trying to hit 1,000 subscribers before the end of summer. Share this video with friends or family who might be interested in investing. I have tons of other videos, analyst reports, etc. on this channel. Make sure to check those out, and I'll see you guys in the next video. Peace out.